Hey everyone, thanks for joining. My name is Al Salus. This is our third webinar, and we will be doing this on a monthly basis. Today's topic is going to be around underwriting. Please write your questions down. It's going to be a very dynamic exercise this time, so hope everyone can engage with me. I don't mind any disruptions. We might run over for some Q&A. I've done this in the meetup in Cyprus here a couple of weeks ago, and we had a lot of good engagement. So if you have any questions, feel free to jump in. Otherwise, you can write it down and we can address it at the end. With that, so how do you underwrite deals like the pros? This is going to be the disclaimer that we always start with. This webinar is for educational purposes. Please do not use this as any advice for any investment decisions. Always consult with legal and financial advisors before you do anything. With that out of the way, here's the outline for today. We're going to touch on the importance of deal flow. I'll speak to that. The no story, no deal, especially important this year in 2024. And I'll speak about why that matters and why is it relevant to the deals that we see today. Value add traps. I'll share a few traps that a few colleagues and a few experts have touched on in the industry of how you take a property and add value and benefit from that value add, and what you should do and what you shouldn't do. Then we'll dig deeper in an example of a property we looked at last year and we were working on. And then I'll show you a sample underwriting and we'll go through some of that detail. And then we'll close with, making an offer and making sure you always close the loop. Like I said, the Q&A can be at the end, but if you have any question that we can jump on throughout the presentation. So the importance of deal flow. So deal flow is very relevant in our industry. We always have these rules of thumbs on how many deals you need to be looking at before you get one. And this is a good ratio. That's a kind of rule of thumb. There's no like fixed equation here, but basically for every 100 deals that come across our desk, we might be looking at 10 with a deeper look and heavily underwriting it and verifying all the data and doing all the comps. And then maybe for every 10 we offer on 5, and for every 5 we win 1. It's kind of like that ratio. So the importance of building a deal flow machine and having access to all the deals in the cities that you're targeting is important, because it's a very competitive market. And if you don't have that deal flow set up, whether you're working with other partners that can bring you deals or you're working directly with the brokers, this is a very important piece that we focus on. In 2023, it was even more difficult to go through, because there was a lot of the deals, I would say, they're either toxic deals or deals that shouldn't have been on the market last year. And it's, we've seen deals that came on the market and went away and came back and went away. So there were a lot of these stagnant deals, and we've actually done a lot more screening towards the second half of last year and early this year than actually digging deeper into the property. So maybe the ratio is like 200 to 1 right now, because we look at a lot of deals and they're like, oh, there's not even any chance we can make this deal work. And then we just focus on the screening process, and maybe we'll do a lot less underwriting. But when we're underwriting one, we're definitely digging all the way and making an offer. So I will actually switch and show you a little bit about what we do in InvestStream. We have created a deal flow setup where we work with our brokers, we work with our partners that bring us deals, and we actually look at other opportunities for deal sources. So currently, the current market where There's a lot of deals that have distressed sellers, financial problems. We started to see a lot of deals coming from the lenders themselves. So we talk to more lenders than we actually talk to brokers these days. Sometimes we get deals also from the property management companies. So it's a lot of untraditional sources of deals as we go through things. And just as an example, in the last 9 months, we looked at 48 deals that didn't pan out. We closed on one. We're actively working on 13 deals in the Houston and the Oklahoma City market. Those are two markets that we really like. And we collaborate with our partners within a platform like this where they can bring in the deal. We have all the history of the information about a certain deal, communicate about, who got the information, what was the situation in that deal, what was the purchase price that we offered, what was the feedback of the seller, etc. And so when we come back to it, even if we don't win it, a lot of times we'll go into the best and final round of a deal. And when we get the feedback from the seller that they didn't pick us, we were like, okay, we have all the information, we made the offer, and we got the feedback on where the seller wants to be and who the top bidder was. And then we come back. If the deal doesn't go through, we already have that information. We've seen a lot of examples in the market, and we offered something in 2022. The seller didn't sell. We went back in 23 and lowered our offer, and the seller didn't sell. And we're like, the offer of today is better than the offer of tomorrow. But it helps a lot when you have all that database of information, not only just the financials, but all the stories behind the conversations with the broker, with the seller, etc. So just wanted to show you an example of our own ratios, if you will, and our sources of deal flow. The no story, no deal is a lot more relevant. Basically, when we used to look at the properties where we will get the offering memorandum from the brokers, most of what we do is multifamily, and multifamily is typically sold via brokers. And we would work with the brokers. They'll have the nice marketing package about the property, the financials, the trailing 12 of P&L, the schedule of all the rents, we call it rent roll. And we would actually look at the numbers, understand what's going on with the property, see if there's any value in it, and then kind of proceed from there without really knowing what's going on the seller side. As we dig deeper into it and we do the tour with the broker and meet the property management and sometimes the owners or representative of the ownership, we would actually start to know like how long they've owned it and whether or not how motivated they are as a seller. But more importantly, in 2023 and early this year, the dynamic of the interest rates being historically high, at least compared to the last decade or so, and then the expansion of the operating expenses. So we got into this nice phase of 2021 and 2022 where the rents were shooting up with the inflation, but now, especially in the last year or so, rent is relatively flat, operational expenses are going up, and interest is going up. And that's taxes, insurance, and labor. And those are the top three drivers of the operational expenses. So with that dynamic, really the margins on every property and the cash flows are degrading and diminishing. And so if there is no story, it's almost like we're in a single family space where we make offers on text messages these days, like we exchange text with the broker or the seller. There's no formality around things. And the first thing we ask about is, why is the seller selling? They should not be selling. Nobody should be selling this year or last year or maybe early next year. And so if they're selling, there's a problem. Either a problem in the team, maybe a dynamic of a team, a problem on the finance side, maybe they're bleeding and they don't have enough reserves, or a problem in the property and they don't have enough capital to maybe complete their business plan and do their renovations and increase the rents, for example. So it's a simple exercise what we're doing now. It's like, okay, why are they selling? Why have they not sold 2 years ago? And why can't they hold it for 2 more years? And that normally gets us to the ballpark of what's going on. We also ask the brokers point blank, because what's a balance on the loan? How much equity are they going to lose if they're going to sell it today? And sometimes they lose all equity, sometimes they lose partial equity, if they want to meet the market price today. So it's a lot of dynamic trying to learn how to work with a seller and to maybe even come up with a creative way of offering something that may get them out of, you know, minimize their losses, if you will, and still make the deal work. There's a big gap between what we normally offer and most of the seller wants. But once we have that conversation, then we start trying to find creative ways of making it work. But sometimes it's just, there's $1 million or $2 million gap between where the market is and what the seller wants. So no story, no deal, a lot more relevant in 23 and 24, before we even dig into the financials and the screening and going through the entire process.
What are some of the storylines you like right now, Al? You personally and your team?
We like that we like operational issues where high expense ratio is a good starting point. Any conversation around rent growth, we're not looking at it. Any broker that says you can do value add, but 50% of the units are already renovated or 70% of the units are already renovated, we completely skip that. So we're not looking for top line growth. The market is going to stay flat and grow slowly. So operational issues, maybe partnership issues, and then upside, any deals that requires injection of capital, where the current ownership may not be in a position to raise more capital to keep the deal going. Right question. Value add traps. So I've touched on a little bit about the value add traps, and this is the most gimmicky thing, right, that you can hear from any broker these days. Is like, oh yeah, this is a value add deal. Historically, value add meant that you buy a property that will allow you to inject more capital in it, elevate the status and the amenities of the units, renovate the exterior, renovate the interior, command a higher rent for that community. We typically look for properties that are lower than the location. So it would be like, a class B location, but a class C property. That way we can push the rents, given the demographics, and we can really in a meaningful way add, do the renovations, increase the rent $100, $150, $200. The market can still accept that because the income and the demographics allow that, and the property is in a lower class than the location. But you see a lot of these that sort of shows up when we are looking into deals. And some of this is, done by maybe newer investors, but I've seen also other investors who try to optimize their process so much and make everything look and feel the same. I know Marquise and I were looking at a property last week in Houston, and that owner of the property has renovated all their properties across different cities and different states with the exact same colors, exact same countertop, exact same everything. And that might seem like a great strategy, maybe cutting costs on the materials and standardizing on things, but every market is different. Like putting this in North Dallas versus, Southeast Houston is a totally different game. And they've owned properties in Florida and Houston and Dallas. And I can see that they're trying to optimize. Even the furniture was from the same vendor, but definitely they over renovated. So that's the first trap, is, not making sure that there's an ROI for every dollar you spend on the property. And typically we like to recover any investment is within 24 to 36 months. So our business plan is 5 years. Any renovation and any capital we inject into a property, we want to recover it in 2 to 3 years. That way we see the benefit, we maximize the revenue by year 4, and then we're waiting for the market to be optimal for an exit. So if this is gonna drag beyond 2 to 3 years, there's a problem. And the ROI. So the ROI is making sure that you're not doing the standardization across all kinds of neighborhoods. Making sure that you're not doing courts when when the neighborhood doesn't, when you're not gonna get that extra rent from it. If you're adding carports to maybe add additional income. Maybe you don't want to do too many carports. Sometimes, people like I've seen a property, by the way, same owner, Marquise, you remember that. They did 80% covered parking. And they got trapped into, like, you can't really make it additional income because most of the parking is covered. So you can't really charge for it because they have to park inside the property. So sometimes it's silly mistakes like that. They did the renovation. They thought they're increasing the income by adding this covered parking, but they overdid it. And once they overdid it, then they couldn't actually recoup some of that revenue. Actually lost most of the covered parking revenue that they had. The next one is only focusing on immediate income, meaning it's almost like the opposite, where they're too laser focused on only doing interior renovation, for example, because that's gonna make, that's directly proportional to the income increase in the rent. But they're not taking care of the roofs, they're not taking care of the exterior, the amenities, things that are sort of intangible, but drag people into the property and, more importantly, keep people in the property. So you can't like swing the pendulum on either side. You have to focus on ROI, but you need to take care of basic things on the exterior, the curb appeal, and the amenities as well, even though they don't necessarily generate direct revenue. And then the final trap, and this is the most common, believe it or not, is not planning the exit. Not planning the exit, not knowing who the seller would be, what the seller would look for. And most of the time, it might sound like a great idea to optimize the revenue to the nth degree and optimize expenses to the nth degree and optimize occupancy, which is great. But if you're already optimal, there's nobody that can pick up this property and actually take it to the next level, because now you're at the top of the market, you're at the top of the rent. You're not really leaving what we call a meat on the bone for the next buyer. So if you're not thinking about the exit on day one, you might get into the trap of you're enjoying the cash flow, you're enjoying the maximum position of the revenue and optimizing expenses, but you might be stuck with that property. It might continue to cash flow for you, but you cannot get a good exit out of it. So plan your exit on day one, and understand we're going to be on the exit cap rate and how much runway you're going to leave for the next buyer, basically.
So on the traps to avoid, right? I think I wanted to cover on the parking lot discussion you made, the comment you made on the parking lot.
No,
So
go for it. Go for
we
it.
were looking at a property in Houston, I think a couple of weeks back, and the property did not have the carports, but again, the parking spots near the building were all reserved. And most of them, I think we checked out all the buildings, all of them had the reserved sign on the parking lot. Only the ones which were outside, like near the perimeter around the fence area, they were the only ones which were not marked. So, so how do you think that is a trap? Again, I just want to explore on that, and what is your thought process there?
That can be a trap of people I mean, how are you going to enforce if you really have more than 50% of your parking as reserved?
Yeah, I think it looked more than 50% for sure.
Right? Like, so how are you going to enforce that? How are you going to actually enforce that people park in their parking and they're actually paying for it. Because what happens is it's kind of like when you go to the mall and the first floor is all valet parking, you
Mm-hmm.
know, it's like, okay, I'm gonna pay for the parking. You're not gonna
Mm-hmm.
pay for the parking for some reason.
Yeah.
And then, it's almost like the free ride in economics, right? So like 60% of the parkings are reserved. Eventually, somebody's going to park in the reserved parking and they're not paying for it, which will force me not to pay for it. So that actually will reduce the income. Exactly. I think we're looking at the same property, probably Mayora. It was exactly the same problem. So they started with 30% covered parking and they decided to go to like 70%.
Okay.
And what they saw once they went to 70%, the income of additional covered parking went to zero or maybe
Hmm.
5%. So it was absolutely the wrong move for them.
Okay. Now this one did not have any carports as such, but only the spots were marked as reserved. That's
It's a
all.
similar problem. It would
Okay.
have a
Yeah.
similar
Yeah. Yeah.
problem. Yep.
Yeah. And no, when you say enforcing, are you seeing the operational challenges there to enforce, or will it lead to some chaos, or how are you looking at this?
I mean, a good rule of thumb I use, it should never be more than 20%. If you're doing
Hmm.
more than 20% of anything, it's not going to work. Like whether it's a dog pet fee or covered parking or reserved parking, think of it as if you're doing reserved parking, it ought to be a value for them. So
Hmm.
if everything is reserved, then it's not really that valuable. If it's really valuable and it's next to their unit and they're just going to walk out of the car into their unit, that's just value to them and they're going to pay for it. It's just an example.
Yeah. Okay.
One of the things we've done on a couple properties, kind of depends on your demo and what you've gotten, what you can get away with charging for amenities, is gone 100% of the units have a mandatory reserve parking spot, but your
Hmm.
fees got to be much more manageable, somewhere between $20 and $30 here in
Hmm.
Dallas, versus
Hmm.
going with trying to get a $50 or $45 bump for something that feels more special, like Al's talking about. So you kind of got to go one extreme or the other. But we have seen some success with forcing all new leases to have essentially a built-in amenity, which is that you're going to have a spot next to your unit. Allows you to really control and identify specific reserved spots. As far
Yeah.
as enforcement, though, I'll say it's pretty darn easy. We are inheriting a mess with our newest project where, there's just, some need to enforce, right? Because people are trying to park where they're not supposed to.
Hmm.
And it's as simple as a relationship or contract with a towing company, and they'll get their signage up. And the people who have the spots will be registered. And the moment that they call in, if somebody's in their spot, that car gets towed, and
It's
that
a,
towing company gets $300-400. So it's not
yeah.
that hard to enforce. It
Yeah.
just sucks to enforce because it just sucks to enforce. And so to
Yeah.
Al's point, you should never have too much reserved unless you're going all in 100% of the units and you've got some structure by which you're allowing everybody to have at least one parking spot next to their unit.
Yeah, it only takes one tow. Everybody's gonna know. But I guess what I was talking about enforcement, it was more like you're gonna actually lose revenue. In that example, like they went from 30% of units to like, hey, if everybody's just gonna keep doing this, then I'm not gonna pay for it. That's just an example. Thank you, Gabe. Thank you, Mayura.
Real quick on the things to avoid. I guess I thought maybe one of the ones. Have you been seeing, Al, like deals where they're really hiding a lot of the problems with accrual accounting? And so, they're, because I mean, obviously that's across the board, but it seems like one of the traps for these air quote value add deals is they look really good if you're just looking at accrual listed revenue, but then they're kind of hiding two things. They're hiding collections, and then they're hiding capex. And I think those are two areas where
It's just
that is a trap I've seen people get into when they're new, or even when they're passive and they're underwriting a deal that their sponsors are showing them that doesn't really account for it in the pricing.
Yeah, I agree with you that be careful of the last 6 months of operation. It's always an intended misrepresentation. So normally they would get everybody and their brother into the apartment to get occupancy to grow. So they will be less strict on the way they're screening the tenants, their income, their background checks. Um, you need to be very careful about the potential rent on an accrual basis versus the delinquency. You need to have to actually compare it to their bank statements.
Yeah, bank balance.
To make sure that they, the cash meets the accounting, basically. One of our first properties, we were working hard, and we saw in the last 3 months they went up from 92 to 98%, and we were like, okay, that's not good. And sure enough, we pick up the property and the delinquency is bubbling, and we have to basically evict these latecomers that came up to that the seller accepted to show up because normally the good logic is if you have an apartment complex where the rent is below market and it's fully occupied, then that's a confirmation that they're really below market. But that's most of the time a scheme, not a real thing. So you have to dig deeper into, like, did they really fill up the last 50 units in the last 3 months, or was it actually really below market and people were just, jumping on that property? So yeah, that's always like you have to read between the lines and trying to find cross look at the data from different angles to find these holes and answer that questions. But there's a lot that happens in the last 6 months before they sell something.
We've been
So
demanding, never before have we done this, but we've been demanding the general ledger. We've been allowing them to sort of X out any of the equity side because we don't care about the sort of the partnership level equity, but we've been demanding the GL, and it's the first time I've ever gotten a yes on that. And it's allowed us to get a really true picture of what they're hiding and kind of pushing around
yeah,
with
same thing from bank statements, like kind of like that was like a no back in the days, and now it's like, oh, everybody should show their bank statements too. Yep. Great point. All right, enough of PowerPoint. Let's dig into a few things. All right, so I'm gonna share this actual property that we looked at several times. We actually did not win this property. It's a property here in North, almost Spring area in North Houston. We looked at this property, I would say the first time in early 2022. And it has some good things that are going for it that are sort of gave us that story. This was an out-of-state owner that had, it looked like they had operational problem. I'll show you why. It looked like they were trying to exit the market in Houston as well. So there was the story of this is a landlord who invested heavily in Houston, and they didn't like Houston and they wanted to exit. And so from that perspective, it really helped us. So the first thing we normally do, part of the screening process, is I look for 5 things in Texas, and maybe one of them is a Texas thing, but I look for Starbucks, I look for HEB, I look for Chick-fil-A, I look for schools and churches. Those are the 5 things you always look for. Schools and churches. In this case, there was even a park, so that was even a plus. The good thing about Chick-fil-A and Starbucks, they will do extensive demographic research. So they've done the
quick
work.
question. So
Tell me.
does this apply for Class C as well?
It depends, but if you have something in proximity, then maybe the property is Class C, but the area is like B minus. So that gives you some runway to actually elevate the status. It doesn't need to be close to you, but it just kind of close enough that maybe within 3 to 5 miles radius. So at least you can confirm that it's an up and coming area. In this scenario, this was a 1979, 1980 product. And it was a high medium household income, supported by the biggest high school in Houston, the HEB, and Starbucks as well. It was like everything was there. So we really liked it. What caught my attention was this creek. So we're like, okay, now I need to check flood. So that's my second check is flood zone. It impacts insurance, and it was right out of the flood zone. So that was a good sign, even though it's a major creek here in Houston. So that made me ask a lot of questions. Did this property flood in Harvey? and we were looking for evidence whether or not this property flooded. But the best people you can partner with to actually confirm flood zone and flood issues is the insurance companies. They will tell you if this is a flood or a risk of flood. Obviously, after Harvey in Houston, for example, FEMA has updated the maps and made more areas of flood zone, 500-year flood zone or 100-year flood zone. But there has been a lot of investment from the city of Houston to improve the bayous and the creeks. And actually, FEMA is now redoing the maps and reducing the flood zones, which is great. And the other thing we've seen is you can actually work with the insurance company, and they might tell you that maybe one building is in a 500-year flood out of the entire community. And so you don't need to like insure all buildings at the same level. I've looked at a property last year where we actually went to an insurance consultant, and he talked to us about contesting the flood map. And they actually went back and measured the elevations and everything and actually removed it from flood zone. So this is actually something that we see happening recently in Houston, especially after the big investment from the city. So I checked Google, I checked the flood zone, looks good. I would check the crime next, high schools, churches. So that's the next steps typically. And then I would go into CoStar. So CoStar is one of the data research companies that are one of the biggest in the US. They do different asset classes. We use most of their data, but some data we don't really like, especially the comps. So we normally look for a second source of comparable rents. But for the most part, they have a lot of good information that can give you a first pass on a property. So we actually invest in CoStar and we have it live for InvestStream, but basically it gives you all the information about the property. And here we go. This is the first sign I look at. It's 20% vacant. This is physical vacancy. So we know there's a problem because when I look quickly at the actual submarket vacancy, it's 14%. And 14% has picked up this year. So it was actually 10%. So for them to be in a 20% vacancy in a market where the average is 14, that's a good sign. So to Gabe's earlier question is like, this is okay. Here's some potential to improve this property without maybe injecting a lot of capital. Now, Texas is a non-disclosure state, but in some properties, they are able to interview the buyer, the seller, and actually understand what the price was in the last sale. That's great information. So in this exercise, when we looked at this property, we knew the owner has bought it in 2018, and it was 14.9 million when what they paid for it. So that gives us an ability to say, okay, whatever we're gonna offer now is we need to compare it to like what their loan balance is, and assume what their equity was and how much money they're really gonna lose. So that's a good starting point for us to understand where they're at. Also, this is a conventional loan at 4.2%. So that gave us the ability to also negotiate a loan assumption offer, since it's a lower interest than the current market. The current market is around 6.1, 6.2 right now. If you want to get new debt for a property like this, with the agency debt, Fannie Mae and Freddie Mac. So that's all great information. We look at the vacancy, we look at the market rent, we look at the unit mix. We always love to see more 2 and 3 bedrooms than 1 bedroom. So if the unit mix is tilted toward 2 and 3 bedrooms, that's always a great thing. It's more family oriented. Families tend to stick where they want to live, especially if you have great school districts. They want to stick around and they're willing to pay a little bit extra over the years, and they actually don't have a lot of turnover, which will reduce your expenses on the turns. So that's also a healthy thing that we looked at. Next thing we look at is the demographics. So this is a demographic of $110,000 of income in 1 mile radius, and this is the medium household income. Another trick the brokers will throw at you, they'll talk about average income. You really need to aim for a median. And so this is a great sign. So it's a 1 mile radius, great income, and it's great school district. So that quickly proves to me that this definitely is an area way better than the property. So there is a lot of runway of renovation that we can take and command that rent. So that's another thing we look at. We look at density and other things. The other thing we also look at is the public record. So the taxes of the property. In this scenario, this was a 2022 assessment at 12 million. I think in 2023, when we came back to it, it jumped to 14 million. So we knew also what the property valuation is according to the city. So that normally we try to see like where the tax is, where the seller is, and understand that as we're making the offer. I'll show you an example of comps. It's not the best. I don't normally like to use CoStar for comps, but they've gotten better over the years, at least for a first pass. And normally I like radius-based comps. For some reason, they like to do the AI-based comps, and I don't like AI sometimes. They use apartment.com. Like if somebody lives in the Woodlands north of Houston and they're looking at this property, they think they're a good tenant. So this is a radius-based. It shows you the average rent. Remember, this was a 119 rent per square foot. The average of the comps is 136. You can decide which comps are more relevant or not and delete the ones that you don't think are real comps. We normally refine the comps as we visit the property and do the tour. We drive around that property and find the ones that really look and feel the same and the same kind of age and demographics. And we like to narrow it down to the top 5. Like we don't look in more than 5 within 1 mile or 2 mile radius. You can see here that most of these properties are relevant, but there are some that are not. So I would remove this one. I would remove anything that doesn't feel like it's the same size, the same age, the same look and feel. And then we dig deeper, and I actually like to work with other data sources. For example, this one is apartmentdata.com. There are other data sources that are more precise. They call on a monthly basis to check the rents and the amenities and their concessions. So I trust these folks a little bit more. And all we're looking for is what is the occupancy around us? Look at this. Like what, this is an older file, but this is one of the games that we were talking about earlier. They were showing 99% occupancy, even though when I look in CoStar and look at the history of occupancy, it was always averaging around 85, 90. So we know this is just a last ditch effort before they sold. We look at occupancy, we look at the size of the units. Obviously, normally the older the units, the bigger the size. So you want to try to compare apples to apples and not have some wishes and dreams about a different property that is not really your comp. And then obviously the market rent. We try to normalize it by dividing it by the square footage of that. And then whether or not they're charging for utilities separately or all bills paid. Some properties will have that included in the rent, and that we need to sort of exclude that if we want to compare it. What we look for is we need to be, when we're looking for properties, the property needs to be lower than the demographic. Ideally, the rent is lower than the comps, and we have truly high occupancy, sustained high occupancy for a while. So that's normally a good starting point. I'll finish the data analysis and then I'll show you the underwriting. So a lot more analytics, but I'll spare you from some. I just want to show you a couple of things here. The occupancy rate. This is what Gabe and I were talking about. This is the property in orange, and then the market is in blue or green. They're actually overlapping, so I'm going to turn off the green. And you can see there are some things that are driven by the submarket. You know, historically it can be an oil and gas price in Houston. Houston is a lot more diversified these days than it used to be. And then you can see here the market dipped in COVID. So we have the first phase of COVID is when everything just went crazy in the first quarter. And then you have this huge demand on apartment units, and you see a big uptick in occupancy. Since then, it started to drop in this specific area, as you can see here, and then this is the forecast going forward. Now, the property is a lot more erratic, right? You can see that it's zigzagging all the way, even when the market was stable. And then it overshot in occupancy when they were trying to sell it. So this is the scheme I was talking about. This is not sustainable, and sure enough, it's not sustainable. And they even, you know, they're a lot worse than the sub-market they're in. So all of this is a good sign, and we'll verify this in the P&L that, you know, we want to see where the rent was and what happened to the rent when they did this, and you know, the history of the occupancy over 12 months. But this is a good indication for us that since their ownership, it has been erratic, and that's not a good sign. It's a good story for us to pick up the property, but that's not a good, healthy operation. The last thing we look at is the market growth rent, the rent growth from a market point of view. So if you do nothing and the market just continues to grow, you can see here the forecast of the growth in rent. And this is a simpler view of, you know, in COVID days, you can see that the rent went up on average between 8 and 12% between, you know, the mid 21 to mid 22. And then rent stopped growing and it went flat, and it's going to continue to be flat probably for most of 24. They're showing a little bit of negative, actually, reduction in rent in Q1. And then it's sort of going to stabilize around 2 to 3%. So it's kind of jump to 3% and 2%. So when we look at a underwriting, we want to make sure that year 3, 4, and 5 of the ownership is aligned with the market, because you can be the smartest operator and we always think that we're smarter than the previous one. But you cannot cheat the market for 5 years. You can cheat the market maybe for 6 months, a year, but eventually you're going to compete with the market. You're going to compete with your comps, and people will know that you're higher, lower, you know, you're not in the same category. And so when we look at underwriting, like I was saying earlier, we're not looking for any revenue plays at this point, unless it's really a value add and we're going to inject, you know, $2-3 million in the property, and we're actually taking the property to a different class, and we can command the rent. But for us to rely on the market, none of our underwriting this year is going to rely on any market, really. So we really need to have a good basis going in. Same thing on the cap rate. Really quickly on the cap rate, as you can see here in the sub-market, I'll turn these off. They're all the same almost. Cap rate continues to shrink since 2013. I think it peaked in 2013 in Houston. And that was like the bubble of oil and gas. And then it came down, down, down. It was historically great. You know, the tides were high. Everybody rode the waves. Everybody made money from 2013 until COVID, and maybe early COVID. And that's basically what this is saying, that the valuation of the property grew by about 13 to 20% on its own, just the market. You know, the interest kept dropping, and you bought it, you ran it well. By the time you exit, it's just appreciated so much. And then since the interest started to peak, and sort of extraordinary Fed action to combat inflation, it was followed by an expansion in cap, i.e. reduction in valuation. So this is now back tying it to the story. No one in their good mind should be thinking about selling. What we're telling everybody, it's actually going to get worse before it's going to get better. So the higher the worse, the lower the lower the cap rate, the higher the valuation. So if you look at this chart for this specific submarket, you probably want to go all the way to late 2026, early 2027 to get the maximum return on the valuation, assuming between now and then you maximize your operational revenue and optimize the expenses. So that shows you that it's actually going to get worse before it's going to get better, but we consider it as a buyer's market. If you find the right property and the seller has come to terms with the reality of where they're in. Any questions or comments?
I have one. I know we're probably running short on time, but this is such an interesting topic, and I'd love your perspective. Using the example of the property you just looked at, it's unstable, so you're going to need a 3+1+1 loan. And I see a lot of people still create a 5-year business plan when in reality, it's either more like a 3-year business plan or an 8-year business plan, and say you refinance into something longer term and you want to keep it longer. But I guess the higher level question is, how are you looking at some of these unstable deals? Because that's the story. I mean, just hearing you say that you like that story was so exciting to me, because that's the same one I've been looking for. These 80% occupied when everything else is 90, 91, 92% occupied is like super fun. These C-class deals that are in B-class neighborhoods all of a sudden, just amazing stories with good schools. And it sounds like you found this when you were analyzing it. If you were to set the reversion cap, how would you look at this chart? Not to forget the fact that CoStar seems to change its mind every 2 or 3 months as of the last couple of years. So it's super frustrating because you tell all your investors, here's the reversion cap rate, look how great this deal is, and then it changes on you. But
I think the Fed chairman changes their mind every
That's
2
true. That's true. That's totally fair. But it has stayed consistent with this little peak,
Sure.
right? Where
Sure,
it's going to get worse before it gets better. And then you've got these people that for years were able to go from 2013 to 2021, where it's like, let's be conservative and let's put our reversion cap a few points above our entry cap.
Yes.
And that's like as gospel that could work. I mean, I don't know how that could necessarily work.
I think the good rule of thumb to answer your question is 2019.
Yeah.
I look at the reversion cap rate of 2019. That's kind of how I look at things. So whether I look at CoStar or not, 2019 is a good rule of thumb for me. Obviously, Dallas is different than Houston. Houston tends to be more aligned with that rule of thumb. Dallas is still growing like crazy. So God bless you in Dallas. There's a lot of competition. Phoenix is dropping like crazy. So those days of buying at 280 a door and 300 a door in Phoenix are gone. Actually, I'm very excited about Oklahoma City. Oklahoma City is almost like, it was slow and steady in income growth. The bases went up like crazy because of free money, but now it's actually correcting on the bases. So you have slow and steady wins the race. There's no insurance craziness. There's no tax craziness. So you're really not fighting so many fronts like you are in the hot markets. Now, hot markets are going to come back next year, but Texas slowing down, Florida is slowing down, Arizona slowing down. So it's almost like that. It's like this year is a lot of Midwest focus, and for us.
And so for Houston, you've been looking back to the year 2019 on your stuff and going, hey, where was it at? I think that's a safe bet for when I go to exit.
Yes. So,
I really like that. That's smart.
In this scenario is like 5.75. I would consider this a 5.75, for example. Yeah.
Okay. That makes sense. Asked and answered. Thanks, Al.
Oh. All right. Then we collect data. So we screened it. It looks good. There's a story. The data's there. Let's dig deeper. Then we start capturing real data. So we go get an insurance quote on the property and make sure that it's an updated insurance quote, because for those who are not following, you should be seeing this in some of your home insurance, and at least if you're in the southern side of the US. Because of what's happened in Florida, insurance in the coastal counties have tripled sometimes. And even in Dallas and Oklahoma City, far from the ocean, we've seen them double too. And the valuation peak, because of the free money, has made all the counties very greedy. Like Tarrant County in Dallas, oh my God, like they really want to take advantage of the the valuation increase to capture as much taxes as they can. Here, Harris County is a little bit more, I would say, balanced in the way they do things. I know there was a new bill that was passed in Texas to try to reduce some of the actual valuation bases used for taxation, just to kind of give the operators a break, because everything just went up, right? Taxes, insurance, labor. There's a lot of fronts to fight. So we get an updated insurance and make sure that they understand. Normally, the insurance companies are good in talking about flood, talking about what kind of wiring, what kind of plumbing. They'll ask the right questions for you to make sure that you're not going into a problem. Similarly, we look at the EdgeCAD. This is the Harris County tax. We look at 2022. We looked at 2023 eventually. And if we see a story where maybe the valuation was so low historically, and now because we're going to buy it, it's going to jump in value. This was when values continued to go up. We used to work with consultants, and the consultants would fight and will contest the tax valuation to make sure that we stay as low as possible. And in certain cases, we would go and actually sue the county, to actually take a judgment that this was misvalued. But we're seeing the opposite now, because now we're trying to tell the county that, hey, we're going to actually buy it cheaper than they bought it, or we're going to buy it cheaper or almost flat to the tax valuation. And so when we look at something like this, it will be like, hey, now we're going to show you the contract, and we're going to actually disclose the price to make sure you don't actually increase it. And in certain cases, I've seen a slight reduction in valuation in Houston specifically. I don't know if this applies to other markets. I don't know, Gabe, if you've seen similar things in Dallas.
Absolutely. Yeah. I mean, well, the whole idea is we're trying to get deals right now. We're probably getting sellers selling at a haircut from what they purchased at. So yeah, this has been one of the big opportunities on the operational side of things, because we're able to cut expenses. The two uncontrollable expenses actually are starting to look like they have some opportunity there. Not that insurance is necessarily going down, but if you know what you're doing, you can at least keep it from going up 5 to 10%, like we've had to bear the last couple of years.
Yep. Awesome. So we gathered that. The last thing we do is obviously we look at the P&L information, and we look at the trends, but we actually go and work with the property management and ask them to provide their budget of running the property. And that's typically, some property management will do it for 2 years, but most of them will do it at least for year one. And that's always a great conversation. We're the asset manager, they're the property management. They're going to run the day-to-day. We're going to have our dreams and hopes of how we're going to actually run the property and make money for our investors. And they're going to be the reality check for us. And they're going to be like, oh, your occupancy assumptions is too crazy. Your rent assumptions is too crazy. They're going to inflate their operational expenses because they want to give themselves some slack. And so it's a typical conversation between headquarter and country, or headquarter and region, where they're setting the budget, we're stretching it, and then we go back and forth until we have a middle ground agreement that they can commit to. So we push them to increase more rent, we push them to improve their revenue, we push them to cut on their labor, for example, and some of their fees and administrative software and other things that they normally try to bake in. And we get to an agreement. That's always a great thing, because A, they verify the comps, they verify the occupancy, and they give you feedback from on the ground. This is the reality of how they're going to run it. Obviously, that doesn't mean that that's how it's going to be run, but at least you had that debate and conversation with them, and they sort of validated your assumptions and challenged some and so forth. So That's always a thing that we look at before we get to the final view of, okay, now I'm going to show you an older version of the underwriting. Full disclaimer, this property is no longer on the market, and we know why. This seller decided to keep it until 2027, and they got additional capital. So, that's why I'm sharing more than I should, but, I'm good with that. This is the underwriting. So basically in the underwriting model, basically we plug in all the rents on this property from the rent roll. We look at the unit mix, all the different 1-bedroom efficiency, 2 bedrooms, a number of units. What is the size of these units? What is the rent of these units today? Actual contracts with actual tenants. This is not an Excel sheet by the seller. This is actually from their system, backed by contracts. And then we look into, okay, where we're going to take it. If we invest the capital, this is where the ROI comes in handy. If we invest the capital, can we actually take the units to these rent levels? So on average, the rent levels went up 100, 150. And obviously, we're not renovating everything. Like I said, we want to leave some for the next owner or next buyer to take it to the next level. So typically, we like to renovate the bigger units and the ones that has more bedrooms. Again, because we're focused on driving the family, and the family are gonna stick if it's the right school district and they're willing to pay extra. So we like to focus on the 2 bedrooms and 3 bedrooms in terms of renovation. And all we're showing here is what it used to be and what we're gonna make it. And today, like when we looked at it the first time, it was 30% renovated. We wanted to take it to like 50, 55% renovated, so we can leave another 40, 45% for the next buyer. We look at how many units were delinquent. So tying that conversation to like, oh, they were 99% occupied, but by the way, 7.5% of them were not paying. So that's a confirmation, because we actually looked at the delinquency balance. We verified the income, and then we started thinking about, okay, what are we gonna do outside of renovating the units? And we have a detailed CapEx budget. We said, hey, that property doesn't have a playground, and so we want to add a playground and a picnic area. That property didn't have enough covered parking. We wanted to improve the security, add cameras, and make it more well-lit property. So we looked at all the things that we can do outside of just improving the units. What we liked is it was minimum deferred maintenance, with the exception of the roof. So we knew we were gonna have to deal with the roof, but everything else was in the right place. Basically the assumptions in this model looks at, okay, how many units, what is the loan assumptions, what is the interest going to be? Obviously, interest was lower when we looked at this. And then what are the closing costs and how much money we're going to inject to renovate the property, and then how much capital we're going to raise to make this property work. Typically, we like to buy and hold for 5 years. Like Gabe said, sometimes it's a 3-year plan if you can actually ride the market and finish your business plan. In any business plan, we like to finish all kind of operational and renovation improvements in 2 years maximum. Ideally in 18 months, but 24 months is a good target. That way we leave year 3. If the market is great, we exit in year 3. But the way we calculate the risks and the way we communicate with our investors, we say we're going to hold it for 5 years. If we sell earlier, we'll sell earlier. We'll make you this, the good money, but we're going to plan 5 years. And we normally aim for 100% return on capital. So if you invested 100K, you get another 100 on top of your money back. And then cash flow is in a lower position than it used to be. It used to be in the 7 to 8%. It's more like 5 to 7% these days, given that the expenses went up, like I was explaining. But this is just annual cash flow. Most of the money will be recouped at the sale as well. So think of any property we look at, we say in year one, we're not making money. Let's take over renovation, fix the operations. Year two into year five will be 6 to 8%, or maybe 5 to 7% these days. And then when we exit, that's another 50 to 60% return. So on average, you get that 16 to 20% year on year after we exit the whole property. So that's if the property doesn't satisfy that with our offer, we're not even looking at it. Now, when we actually get to that number, now we're going to negotiate with the seller and see how we can work with them. But that's our starting point. So we looked at the CapEx, a little more details about like what are we going to do to the interior and the exterior, line item by line item. We look at the closing cost in terms of the bank and the lending and all the taxes and due diligence reports that we need to run. We analyze the other income. So this is the ability to introduce new additional fees or income outside of increasing the rent. It's a tight balance. If we have a heavy value add business plan, we want to make sure that we focus on the rent first. And once that's stable, then we can introduce other income opportunities. In this example, this is one of the tricks that Gabe talked about. There were a lot of miscellaneous charges here and there, $5, $8, $10. We like to bring them all together under one, what we call a community fee, and charge them like a mandatory $25 community fee. But we normally like to make sure that we have actually events for the community, maybe a movie night, maybe a picnic, like something around the holidays. So it's not just, an empty promise. Pet rents, we actually looked at the pet rent and found out they're not enforcing the pet rent. So we saw an opportunity to investigate that and actually charge them for pets. We didn't want to do valet trash. We also saw that rental insurance was not mandatory. For all of our properties, we like to have rental insurance as mandatory, and we offer it to our tenants, for example, for $15. Reserved parking, covered parking, we try to stay very mild. Like you see here, this is 161 units, Mayora, and we said reserved parking should be only 10, and covered parking maybe 50, like not more than that, and you barely can do that anyway. There were some units that we can add washer and dryer, for example. And the washer and dryer is a little tricky because if you do washer and dryer, you want to make sure there is no washer and dryer contract in the building, the coin-based washer and dryer. Because if you have a contract, you're not in the contract, you cannot really rent washer and dryer in your units. So we look for that. Sometimes we look at opportunities like this, where this was a nice wooded area backed by the creek. So we said, okay, if we make a private yard for the first floor units, that will give them a nice sort of backyard, and we would charge them for that. And we said we want to do 24 of those in this property. And then the last thing, we look at utilities. Sometimes we see that maybe they're not charging for the utilities like it should be. Especially in the older properties, there's shared meters on the water and the gas. And if they're not really doing what we call rubs, which is basically charging them based on consumption, sometimes there's money left on the table. Maybe they're not using a good administrative agency that handles the billing, etc. And sometimes that actually matters. Finally, we look at doing this over 3 years. So whatever we try to implement, you're not going to introduce all of these fees in 1 year. That would be a dream, and it's not even a good idea. So I like to divide it normally as 40% in year 1, 40% in year 2, and 20% in year 3. Sometimes I even abandon year 1 and focus year 1 on increasing the rent and the renovation of the units themselves, and then go heavy in year 2 and year 3. No, we're running over, but I'll finish with the cash flow model. And so basically the cash flow model is a 5-year view of rent increase, top line, expenses, bottom line, and then where the cap rate is going to be at the end, and then minus the sale of cost. So this would give us a good comprehensive view of our assumptions on vacancy, our assumptions on revenue, our assumptions on expenses, and then showing us our pro forma for year 2, year 3, year 4, year 5. And if we're exiting in year 5, then this is the year that matters because the valuation will be based on either year 5 or year 6, actually, 1+ year. I'll pause here. I went so fast. I know maybe we need a round 2 for this, but I'll open up for questions or comments before we wrap it up.
Hey, Al, John here. I got a question for you.
Hey, John.
Hey, thanks for this. Super helpful, man. I wanted to get your input on vertically integrated operators. Say, for example, the lead GPs running the property also have their own property management company. I've seen both positive and negative impacts or implications of those. I just wanted to get your opinion on that.
Yes, great question. Typically, it's great to be vertically integrated. That means that you're a big operator that owned maybe more than 10,000 units, and now you bring in property management in-house. So that's always a good story to remove some of the overhead that you would pay third-party property management. But the problem is, if you're not going to pay that overhead, what happens normally is the property management becomes just a cost center, and the operator will feel like, okay, I'm saving myself in my properties, but I'm having too many staff, or I have now a machine of regional managers and district managers and accounting and other things, and they'll be like, hey, can we make a company out of that? And that's when they get distracted, because now they want to try to create additional revenue streams. And I've seen that backfire a lot of the time, where they bring it in-house and they try to monetize it really quickly and try to manage other people's property. So that's one problem. The second problem is a funny money business. I've seen it in big corporates, and I've seen it in real estate. The funny money is basically the intercompany charges are fake. They're not real. And so pay extra attention to the properties where, operating expense seems so low, and you'll be like, oh, that's great. But like, no, that's a function of how they're charging each other inside the property. They might be injecting some capital behind the scene into property management, but you don't see that. And actually showing lower expenses on the property itself to give you a better NOI, so it's higher valuation, but they're actually injecting capital behind the scene and you don't know about it. So that's one trick they do. Another trick is they might not be paying for certain company-wide systems, so it would not show up in the NOI. So it's good from a valuation point of view. But you'll be, when you take over the property, so maybe if you're investing passively with them, it's great because your NOI is great and they're going to exit nice. But if you're buying that property, you're going to discover that their operating expenses were so reduced, artificially reduced, right? So those are just traps that I came across. I've seen them in big companies and I've seen them in real estate. But vertically integrated is always a good sign, whether it's on the operation side or on the renovation side, on the CapEx side.
Good stuff. Thank you.
Yep.
I would just add in that the CapEx or vertically integrated on construction also presents itself with the same kind of funny money concern areas. One of the things that sometimes people do is they do the little money grab where they decide to make themselves a contractor, since it's so easy to do in Texas. Anybody could be a contractor. I'm technically a contractor. And they will buy deals and promote them as money makers because they know it's going to take 5 years for people to get in their deals and realize they're not quite hitting the mark, but they're going to get paid on the construction arm of it right in year 1. So it's just something to keep a close eye on. I know
an example I'm not going to mention, but yes.
I think we're probably all thinking some of the same examples, actually.
They made
hopefully
their
people won't be around over the next couple of years.
Yeah, they made their money on the GC fee and they screwed up their investors, basically, is what you're saying.
Yeah. But along those lines, Al, for underwriting purposes, when you start looking at something from a CapEx perspective, sort of what's your mental process as you get your mind wrapped around how much
Separation of duties is the best approach. Is make sure you get third party this, third party this, third party this, so you don't have conflict of interest. That always is a good exercise. If the property management is somehow gonna tell you like this property is gonna operate well or has operated well, I don't take that I would bring a third party. Same thing on the GC. Just like I would treat insurance and taxes, I would treat operations and CapEx. Separation of duties is always great. That's how I would look at it.
Yeah, one observation I'm seeing on this T12 versus T3, the net rental income, right? There is a big jump there,
Yes.
almost 300K. So that explains the last 3 months or the last 6 months activity.
Yeah, this is kind of funny. Like this is that cruel game that Gabe talked about, right? They have new contracts. Accounting wise, they're counting that money, but it's not real. They just inflated the latest contracts. Yeah. And the people who showed up potentially, they knew they're not gonna pay this rent. They were just playing that fishing game. Yeah.
Well, you guys are out of my market, but I'm going to ask that you guys try to hold firm to this too. I think the days of buying and paying on pro forma are over. And I think that we should be pushing people to really value based on T12 and, at least as close as possible to that valuation as we can be reasonable about. Because I just remember watching everybody do T1, T3, T1.
Yeah.
It's all, it just looks so great. Hey, look, last month they collected this. Just extrapolate that. You're going to be rich. And I think that we're seeing that that's biting people in the butt from having done that the last couple of years.
Yeah, and it's unfortunately there was a lot of millionaire made gurus that should have promoted this. Let's ride the wave. Everybody's getting rich. Everybody was sugar high with the free money, and all of this is gone now. So we're now back to how you should evaluate a business. And this is a business. We're evaluating, hundreds of units with hundreds of tenants and 15 to 20 employees each. Should treat it just like you would evaluate buying a company. So it should not be any different. There's a lot of lucky people who made it, and I don't like lucky underwriting.
So Al, quick one last question. So you said you made an offer on this property. So what was the reason for making an offer?
Oh, so many great reasons I was telling you all along. But the reason they did not accept our offer, we were lower significantly twice. And they realized they're gonna actually sell this property below the loan balance. And that's when they actually went back to their investors and raised more capital to float it until 2026, 2027.
Okay.
So now, never know, this property can come back. We'll see. We'll keep an eye on it. But we have a rich history on this property. We know the owners. We know like what happened from 2018 until now. And that's how you win deals. This might come back, but at this point, we know that they raised capital to keep it for longer. So
yeah, cool.
Awesome. Well, thank you so much for your questions and engagement, for attending today. We will be doing this the second Tuesday of every month, different topics, different guests, but appreciate your attendance and feedback. Have a good night.